Hello there. If you are new to cryptocurrencies, this video is for you. In this video, I will cover the 7 common mistakes that beginners make when trading cryptocurrencies. But before we get into that, I am going to do what I always do, which is to remind you to press the like button, subscribe to the channel, and click the notification button so that you get the alert when I issue a new video. With that out of the way, let's get started. Cryptocurrencies have captured the imagination of investors over the last few years. Nearly 1.5 crore Indians hold cryptocurrencies worth 15,000 crores, and research suggests that more Britons invested in Bitcoin than stocks and shares in the last year. Yet if you are new to cryptocurrency, you are likely to make some mistakes along the way. Mistake number 1. Not knowing if you are trading or investing. Before you buy any cryptocurrency, it's important that you ask yourself if you are trading or investing. Cryptocurrencies are extremely volatile and there is substantial risk of loss. Deciding whether you will invest or hodl or whether you are looking to make a quick buck will decide how you plan your trades. As a hodler, you may have some leeway as you are prepared to hold your crypto for longer periods of time. An established cryptocurrency like the Bitcoin or an Ethereum may be great to hold on for longer periods because they are likely to keep rising. On the other hand, if you are in it just for trading, you will need to plan your trades. It's important to remember that if a cryptocurrency can rise 50 to 100% or more in just a few days, it can also crash by the same margin in that period. The key in such scenarios is to have a predetermined exit plan. Not planning your trades could mean that your stay in the markets may be short-lived. Mistake number 2. Leveraging. If the recent fall in cryptocurrency markets is an indication, then leveraging in cryptocurrencies can be the single most devastating endeavor you can undertake. When an asset is as volatile as cryptos, employing leveraging is adding more risk to an already risky proposition. As a beginner or even as a more experienced investor, you would find that leveraging is the fastest way to lose your money. Most people who leverage do so out of greed for higher profits without realizing that higher profits mean higher risk. Mistake number 3. Risking more than you can afford to lose. Did I mention that crypto is risky? Consider this. Recently, a buggy code led to Titan crypto token to crash from $60 to near zero level. This happened in a matter of hours. Though it seems after a delay of about half a day, the token holders were able to get back about 75 cents for every $1 they initially invested. But this should help you understand that the risk when investing in cryptocurrencies is not just limited to market risk. In a rapidly developing space like this, you can expect the unexpected, especially in coins which haven't been around for a long time. It is for this reason you should make sure you do not invest money you cannot afford to lose. Mistake number 4. Not managing your crypto holdings as a portfolio. If you have been in the stock market for some time, you would know how important it is to look at your holdings as a portfolio and manage them accordingly. This means allocating capital based on risk of individual stocks. Ideally, allocating more to bigger companies and relatively smaller amounts to smaller companies as they are considered to be more risky. Then you may not want to hold all the stocks from same industry, so you may diversify into stocks from different industries like banks, pharma, textile, etc. The same concept holds true in crypto. If you look at those cryptocurrencies which have been around for a period like Bitcoin or Ethereum, they have a solid history behind them. Hence, they have the track record to be considered for substantial allocations in your portfolio. However, the relatively newer cryptos should have relatively smaller allocation because there is a lot of work to be done and there is a risk to how these projects turn out. Similarly, you should not allocate all your money to the same type of coins. For example, you should not just invest all your money in DeFi coins, and you definitely should not go all in on a single DeFi project. Instead, it's better to put majority of your money in established projects and relatively lesser amounts in newer, more risky projects. Mistake number 5. Falling for attractive offers from new exchanges. It is not uncommon for exchanges to partner with influencers to onboard new traders on their platform. However, not all influencers may do proper due diligence before entering such partnerships. This means ultimately you will need to do your own due diligence. Generally, longer an exchange has been around, lower the risk in dealing with them. Newer exchanges may offer attractive options and newer products, but without a reliable track record, there is always a risk they may not keep their end of the deal, or worse, they may even run away with your tokens. Then there is also the security risk of hacking, which may result in your valuable tokens being stolen. Generally, older exchanges are likely to be more secure because of their past experience in dealing with these issues. Mistake number 6. Not checking the regulatory scenario with respect to banks. Not all banks are crypto friendly, so before you use banks for transacting on exchanges, it's wise to find out if your bank is crypto friendly. People have had their accounts blocked for trading in cryptocurrencies. The regulations and directions to the banks from different regulators keep changing, and so you need to keep yourself updated with respect to the same. I would also advise you against doing many small transactions, and instead I would recommend that you do fewer larger transactions, as that way you can minimize the risk of missing on regulatory changes. Mistake number 7. Not owning a hardware wallet. If you are owning crypto, it's must for you to have a hardware wallet like Trezor or Ledger. You may think it's safe for you to store your crypto on exchanges. However, there is always the risk that the exchange's systems get hacked and you may lose your crypto because of it. This has happened before, and it's possible that it may happen again. There is also the risk that the founders behind the exchange may be corrupt and they may try to swindle your money. So it's best to transfer your crypto to your own hardware wallet. With this, we have come to the end of this video. I hope you enjoyed it, and if you did, please remember to press the like button and subscribe to the channel. Thank you for logging in.